Hi guys, welcome back on the Blockworks YouTube macro channel. This is Alf speaking, and today's guest is Mr. Blond Macro, who is the author of one of the best macro Substack out there. It's free, by the way. It's called Stuck in the Middle, and you should definitely subscribe. It's full of good content. He's a prolific contributor on Twitter as well. The handle is at Mr. Blond Macro, if I'm not mistaken. Hi, Mr. Blond. How are you doing?
I'm great, Alpha. Thanks for having me. It's good to see you.
It's a pleasure to have a chat with you every time. So I think what I want to start from is financial conditions, because the subcomponents of that index, dollar, real yields, credit spreads, equity valuations, all of those are contributing to tighter financial conditions. And I know that they fit very well into your macro framework. So can you walk us through a bit what's going on there?
So, clearly financial conditions had already been in a tightening trend from late last year. I think what's interesting recently is that trend has accelerated or has moved at a quicker pace, particularly in the last few weeks, driven primarily by real yields and the dollar. We could talk about the different components of FCI if that's interesting. But I do think it's important to think about the cumulative effect of FCI tightening. And the idea that the tightening is happening again at a quicker pace at a higher level of FCI, I think is it's important to acknowledge that and think about what that means for broad asset markets, as well as what that will likely mean for future growth, i.e. lower. And just to kind of put numbers to this, even before we got set up, I was looking at using the Goldman Sachs Financial Conditions Index. I mean, the last 15 to 20 days has basically been the quickest pace of tightening that we've seen since the cycle started late last year. I mean, it's on par with what we saw into mid-April as well as into mid-June. And at both points, represented important turning points or weak points in markets.
And that is important, Mr. Blond, because in your framework, you both look at the momentum of tightening in financial conditions, which subcomponents are moving, but also the cumulative impact of these tighter financial conditions. So can you walk us through a bit how that really feeds into equity valuations, for example?
Yeah, so I think that, obviously there's the relationship of, a discount rate or, cost of capital. And so that's an important one. It's both a combination of level of rates or, treasury, rates or government rates, and then credit spreads on top of that. So, I mean, in my valuation framework, I tend to rely more on triple B corporate credit as a proxy for cost of capital rather than 10-year yields. There's not a company in the world that can borrow at the government rate. But then I think the other aspects of FCI are important to consider too. I mean, I already mentioned credit spreads, but the dollar. The dollar has obviously made another kind of breakout move here, despite the persistent calls for the dollar's demise, twin deficits and, central banks acting like EM central banks, all this other, stories that are talked about, yet the currency is not acting that way, which I think is, a function of a few things. But that matters to equity markets as well, because the dollar, the transmission mechanism is that the dollar, usually results in weaker profit growth, or more specifically, weaker, sales growth and the translation effect from that. I mean, in the model that I use and have published, a 10% move in the trade weighted dollar that is, somewhat lasting or hangs around for a bit, usually shaves 150 to 200 basis points of growth off of next year's or off of earnings growth over the course of the next 6 to 12 months, which is not immaterial when you think about kind of a run rate of 6 to 7% or 7 to 8% earnings growth on average.
Now, this might be a dumb question, but for the audience especially, what is the mechanism for which a stronger dollar and a sustainably stronger dollar actually hits sales growth amongst U.S. companies?
Yeah, I mean, the basic or the main issue is that, roughly 40 to 50%, roughly 40% of S&P 500 revenue comes from overseas. And, it's true there, some companies are going to be better at others at hedging that FX exposure. But what you find, and then typically what happens is on average, the flow through to EPS is 100%. in that if your sales have a 2 or 3 or 5 or 10% headwind, that's going to kind of flow down to the bottom line. And not to be too disparaging to the analyst community, but most of them are not forecasting that in their EPS forecast. FX is kind of considered an exogenous force, and so that's kind of the main effect. I think there's also the associated effect of like, why is the dollar strengthening? I mean, usually the dollar is strengthening, and we think of the dollar smile, usually strengthening an environment of weak global growth, and so that's I think that's another associated effect and how it flows through to valuation.
But Mr. Blond, one dissonance against the past right now is that a stronger dollar on slower global growth, and that happens mostly because there are a lot of levered foreign entities to the dollar that require strong growth to service their dollar liabilities. When global growth slows down, there is a dash for cash dollars, of course, to repair this balance sheet mismatch that is structural and out there. But generally speaking, there was one component of the financial condition index that tended to help when this was the case, which was real yields. So real yields tend to reflect the monetary policy stance and long-term real growth. And when real growth was slowing down and the monetary policy stance was supposed to be accommodative to rescue this slowing down of growth, you normally had real yields actually rally. But right now, we have real yields compounding the problem of tighter financial conditions and spiking up. So what's your take on real yields? How much is the Fed influencing those, and how do they reflect across sectors in the equity space?
Yeah, I mean, this is probably a better question for you. It's your space, but I would definitely be interested in your perspective. Look, I think clearly the Fed has sort of underscored, I think particularly at Jackson Hole, their focus on kind of beating the inflation problem, and I think that certainly has served to result in another upswing in real rates. Obviously, I guess when I think of real rates and the dollar, these are not mutually exclusive. I mean, I think if one of the reasons that the dollar is strong is because U.S. real rates are outpacing real rates in other parts of the world. I mean, you can look at a chart of 5-year real rates in the U.S. versus 5-year real rates in Japan, and it looks just like JPY. So there's a lot of associated, market movement. I think that's all part of what drives FCI. FCI is a function of multiple markets, and so if all of the FCI tightening was coming from, had to come from real rates, and you didn't get the benefit of dollar strength, then real rates would need to be much higher than they are today, to have the appropriate impact. What does it mean for equity? I mean, obviously, from a standpoint of the discount rate factor, if I think of this, kind of simplistically, I say, well, if I can get, 1% real rate, i.e., real risk-free rate, adjusted for both duration, and inflation and whatnot, then that makes it a more attractive source of return when I kind of cross over and I look at, whether it's like triple B, credit rates are, or where, equity earnings yield might be. And so that can be a big sucking sound from risky assets, towards quote unquote safe assets.
Yeah, that's one of the channels, right? I mean, one is the discounting factor of future cash flows that we discussed already. The other is simply the allocation of capital. When your risk-free, inflation-adjusted alternative becomes more palatable, obviously marginal capital is going to flow towards that, unless risk asset valuations adjust accordingly. So that's what anecdotally happens as well in institutions, and I can testify towards that behavior. But I found very interesting, by the way, Mr. Blond, what Powell said at Jackson Hole on real yields. Actually, he was pretty vocal for a couple of months, but markets weren't actually assigning a lot of weight to his words there when he said that he wanted to see real yields being positive across the curve. So you always had 10-year real yields in positive territory, 20, 30 years as well. But the front end was still in negative territory because they basically weren't pricing the Fed hawkish enough to be restrictive for long, starting immediately now, but also keeping it for the next 3 to 5 years to basically bring inflation all the way down. And after the Jackson Hole speech, which I found very clear, pretty much unambiguous, the bond market has adjusted. And now, as you say, 5-year real yields are actually, I think, the highest since 2018. And don't forget, in 2018, Powell was saying stuff like, we are on autopilot, neutral rate is far away, we'll keep hiking. This was the kind of attitude he had back in 2018. So I think having real yields back there is a testament to the market being more serious about the Fed. But what's your take on the Fed going forward? What do you think they'll be doing over the next 3 to 6 months? Respect forwards, do more on the QT end maybe? Give us a bit your download there.
I think the Fed delivers the expected rate hikes over the course of the next couple meetings. I think that the debate really stems from what happens to the growth environment into fourth quarter. I mean, I have I think I have a more downbeat, kind of negative growth view than the average investor, particularly on the profit growth side. And I think profit growth ultimately determines a lot about what happens in employment growth and CapEx growth and sort of other aspects. And so that's why I focus on profit growth. I think growth has already shown signs of weakness and strain, maybe more so in other parts of the world than it has in the U.S. I mean, I think the data coming out of Korea and Taiwan in particular, which are sort of key early stage important global manufacturing, global trade hubs, looks pretty nasty. So I think if we get that sort of, if we get that growth outcome into the fourth quarter, then I think that could change a little bit, specifically what the Fed does. But I think as for now, I think they're trying to play their hand in a way that suggests we're going to stay here until that happens. I guess one of the things that was important for me, and as you said, I think Powell had already alluded to this, but I think he underscored it at Jackson Hole, which is the Fed is expecting and anticipating and in some ways hoping growth will slow in order to do the inflation fighting for them. I mean, that's kind of this is the don't fight the Fed mantra. This is where it comes from. And I think that, to me, that says that the Fed is willing or will be more willing to accept quote unquote pain to households than it has been in the past. I mean, I don't know what your interpretation is, but my interpretation of pain to households was code word for we're expecting a recession. I mean, I know that it's kind of not characteristic for central banks to talk that way, but that seemed to be pretty close, or as close as you get to a central bank saying, unfortunately, we know that this means a recession-like outcome. And then he followed that with needing growth to be below trend for some extended period of time in order to satisfy this. So this seems now maybe they don't end up hiking a lot more. I think they deliver the hikes, and then I think their focus is to then stay there, probably for longer than most of us would have anticipated a few months ago.
I also noticed the words that you highlighted here, Mr. Blond, the unfortunate costs and pain to households, which in central banks jargon, given my experience, mean that the probability of a recession is higher in the Fed's model than it was 6 months ago. And most importantly, those are unfortunate costs that the households will have to face, and they won't deter them, let's say, from their hiking cycle. It's interesting to see the bond market as well, pricing a terminal rate, which is not vastly different than what it was before, 3.75% area. It's where it seems the bond market has made up its mind. The Fed funds will be at the highest point in this hiking cycle. But importantly, the bond market has now priced away cuts in 2023. Because if the hurdle to cut rates is so high from the Federal Reserve, they're not even a recession, apparently in their own word today, is going to lead them to cut rates. Why would you price any cuts? Although I know that you have a different view there, because you always say that, I think you have a very interesting mantra, which was from Fed hikes, from inflation hikes to growth cuts or something like that. Can you walk us through?
Yeah, no, I think that the concept or the narrative there is really about the I don't know that at this stage or, from a couple months ago when I said it, that anybody was really that surprised anymore about the Fed's, focus on tightening FCI and raising rates. I think that the focus now shifts to the consequence or the cost of that policy of fighting inflation, and the cost of the Fed, choosing to go later and faster instead of earlier and slower, as it in its own kind of transitory and all the other stuff that we talked about in 2021. And so now the cost associated with that is growth recession, right? Whether that means like an actual NBER defined recession, or you just have a profit recession, or you have pockets of negative or really weak growth in some areas, I think is beside the point for markets. And I think that that's where the focus shifts, and we've already seen it in some pockets. I mean, you've been upfront and forward about sort of yield curve flattening. We can see it in internal measures of the equity market through cyclicals, defensives, increasingly seeing, I think, it play out in commodity markets. I mean, all assets that are sensitive to the growth factor.
Yeah. So when it comes to what are the implications for the equity market, because I think a lot of people are basically just waiting for me to ask this question now to Mr. Blond, is can you give us your assessment and your base case scenario for the US equity markets going forward after all the macro picture that you just highlighted, and also some sector analysis, because you have been very vocal, for instance, on transportation or on home builders at the beginning of the year. You were very bearish there. So can you give us as well a sectoral overlook?
Yeah. So I think for the market, I guess like where I do think that we've gone through some important phases or transitions this year. Like I would say we started 2022 with the idea that we had peak liquidity, peak valuations on peak earnings, and that's a pretty tough starting point.
Yeah.
I do think that on peak liquidity and peak valuations, we've made good progress, meaning the market has done a good job to date of kind of taking those away. We still are sitting in an environment of peak earnings, and for me, that's you look at how far above trend EPS is, and that still represents a pretty important risk. I do think that as we go into 2023, we'll find that those numbers will come down pretty substantially. And it's not an environment yet that supports valuation expansion. And so you kind of just do the simple math of a more reasonable valuation on a lower EPS number in 2023, and you can kind of get to kind of measures of quote unquote fair value that are closer to 3,000, 3,200 on S&P 500. So I view that as being kind of path of least resistance, and the idea of that we will have periodic rallies or counter trend rallies because sentiment is more compressed than where we started the year, and positioning is in a different place, and obviously everybody this is why the pain trade is never really higher, right? I mean, everybody would much prefer if we had a market that was moving up and to the right, and so that we'll flirt with that, but I think it's a trading environment that still is a one step forward, two steps back, or if you want to call it kind of sell rallies mentality. I think that we're still very much there until we either see one of two things happen. Either you have the Fed makes a clear, definitive pivot. Pivot is in my mind is not necessarily a pause. A pivot is a change in direction or a change in attitude, or you have various growth leading indicators show a more definitive bottom and starting to turn up.
Yeah.
Now, I think that this is a not mutually exclusive relationship, and that it's more likely that the Fed pivots in response to growth indicators moving lower, and therefore, the narrative shifts away from inflation and more towards growth, and that becomes more the focus. But those are things that I'm looking for. On the sector front, I think unfortunately the story is very much the same, which is to stay as defensive as you can within your equity allocation. So if you're required to be a fully invested equity investor, I mean, you want to favor cash flows that have a really low beta and reduce cyclicality. That will continue to be an issue, and I think increasingly you want to obviously balance sheet leverage. I think will increasingly be a problem given level of rates and the change in the cost of capital. It's certainly become more complicated and harder. I mean, even the energy sector in the last few months is no longer, a source of, kind of the consistent, returns that it was in the first 3 or 4 months of the year. So I think that's all part of a transition, all part of a phase of what has to happen in a market for it to really have the, kind of the proper, capitulation that we'll have to see before we can have a durable up move.
Before I ask you some questions on the sectors, can I ask you, to do the simple math for us when it comes to 3,000, 3,200 S&P 500 base case, or at least path of least resistance for 2023?
Yeah, so I would say like for 2023, I see a number that's sort of closer to $200 on S&P 500 EPS. I think consensus right now is around 240.
Wow.
Or maybe it's probably come down a little bit. $200, kind of gets you your, roughly, 15% below 2022. It lines up with the kind of surprise that you would see when we have the, ISM PMI cycle. It's pretty consistent with the idea that, we're running 25% above trend. And so an EPS number that, kind of falls back to trend. And I think if we were to look at the impact or the cost associated with both the combination of, rising rates or the discount rate coupled with a pretty sharp increase in energy costs or input costs for companies, these are the types of preconditions that exist before you have a more meaningful growth slowdown. So I think that's pretty consistent. I mean, 15 times that number, 16 times that number, whatever, plus or minus is kind of how you get there. I think that those are reasonable valuations given, quality of index, how some things have changed in the composition of the S&P 500, but also, probably represent, a more kind of stable, kind of average valuation versus what presumably will be a trough or near trough EPS number.
And now I have to ask a question about the trough and bear market, because you have done quite some statistical historical analysis on bear markets and bear market rallies. And I know you have quite a strong opinion on when historically has the market troughed, both on a combination, let's say, of EPS downgrades and valuations. So when is that moment where you feel, at least looking at history, it's statistically significant to say we might be near the trough? This
is actually an area where I do want to do a little bit more work. And so one of the things that I want to study in a little bit more detail is, kind of what happened, let's call it like sort of pre-1990 troughs or pre-1985 troughs versus post.
Yeah.
But on average and reasonably consistently, I think you find that the market tends to bottom, kind of 6 to 9 months before EPS bottoms. Mm-hmm. Okay, so and I think EPS will bottom probably third quarter of 2023. That's my current sort of best guess. So if I think about when the market price can bottom, I would say that window opens sometime after October, November this year, and sort of extends into the first quarter of next year, recognizing that, I'm giving sort of average duration of sure. the lead, but it can range anywhere from 6 to 12 months, but is been reasonably consistent around that, kind of 9 month, time frame. So that's, to me, that's when the window opens in the context of how I see, the picture that I see today. I don't know that I really have a strong view or the case to suggest that this will be a quote unquote bear market that that should last for more than 12 to 18 months. I mean, we don't necessarily have well, be careful, I guess, how I frame this. I don't know that we have structural issues as much as we sort of went through a pretty significant shock, and we're digesting that shock and all of its ramifications. That obviously is probably still to be debated. But also remember, like, a bear market bottom doesn't necessarily mean that you have to make new highs.
Yeah.
It just might mean that you're sort of no longer falling, or the trend in the market it starts to flatten out and maybe can be an uptrend. It doesn't mean that you have to have a 45-degree angle to the market.
Mr. Blond, for people who don't know you yet, I don't know how that's possible, but assume there will be people. Where can they find more of your work?
Sure. Well, yeah, I think you highlighted at the outset, but I mean, I think Twitter is a great place to start. I try to be topical and on ideas there. It's at Mr. Blond _macro, and then the place to to find a little bit more detail and studies and written work is at Substack. Stuck in the Middle at Substack is where you can kind of find a little bit more thought behind the charts.
Yeah, both the Twitter account of Mr. Blonde and Stuck in the Middle, his Substack newsletter, are excellent. Free content. There's nothing best we can ask for. Thanks for being here, Mr. Blonde, and I'll check out with you in the next 2 to 3 months to talk about the S&P at 3,200 then.
Yeah. Thank you. It was great to be here. I appreciate the always strong and pointed questions.
Thanks. Talk to you soon.